So after a break from major purchases in recent months, Warren Buffett is back to his old tricks, as he announced the end of his recent drought with a $10 billion bet on energy. To be specific, Buffett's company Berkshire Hathaway broke its silence at the end of a holiday weekend with its biggest acquisition in more than 4 years. The $9.7 billion deal for Dominion Energy's natural gas pipeline and storage assets signaled to the market that Buffett is willing to pounce, despite his cautious tone in May. Okay, so we're going to be taking a look into the details we know about Buffett's biggest deal in over 4 years, and most importantly, what this means for us by analysing as best we can what Warren Buffett is thinking about the stock market today. So let's get straight into it. So while Americans were celebrating the 4th of July weekend, Buffett was lining up this deal. If you're American, by the way, a happy belated 4th of July weekend to you. I hope it was a really good weekend for everyone. To some people, this purchase from Buffett may have come as a surprise. In fact, with his recent sale of all airline companies and trimming certain positions in his portfolio, I have to hold my hands up and admit I wasn't expecting to see a major investment like this so soon afterwards. And I'm not the only one either. As noted, his inability to make a major acquisition recently has drawn scrutiny from his critics, who have argued that Buffett has lost his ability to pull off the game-changing transactions that helped vault Berkshire into the ranks of the most valuable US public companies. Now, let me jump in for a second. This does make for good reading, but the idea that Buffett has lost the ability to pull off game-changing transactions, I mean, come on. But still, the deal to buy substantially all of Dominion Energy's natural gas transmission and storage assets for $4 billion, along with the assumption of $5.7 billion in debt, shows that Buffett is willing to put his money to work. With Buffett quoted as saying, "We are very proud to be adding such a great portfolio of natural gas assets to our already strong energy business." As Darren Pollock, a portfolio manager at Cheviot Value Management, notes, he's inspired to see that, given Buffett is bearish, he's still willing to make acquisitions where he thinks it makes sense and where it meets Berkshire's hurdle points. Okay, so there are a few points to unpick here. The first is that we really shouldn't be surprised. As we know, Buffett has built up a reputation as an investor who thrives during the bad times. He is renowned for his ability to swoop in during difficult economic times and invest into companies that he believes have dropped below their intrinsic value. However, in a way, the surprise comes from his lack of activity during the previous market crash in March. Many of us investors, myself included, were expecting to see him take this as an opportunity to swoop in as usual. And when he didn't, this is when we began to question if he views the market very differently today to how he did in 2008 and in previous crashes when he was famously investing in spite of so much fear in the market. So is this recent purchase an indication that Buffett's opinion on the market has changed? Does this now mean that Buffett is bullish? Well, unless you are Warren Buffett, you really can't know what he's thinking. But as I often tell you, my favourite way of gauging the market is to look at the world's best investors, people like Warren Buffett, and to analyse their actions. Remember, it's his actions, not his words, that we're paying close attention to. Well, as noted here, the announcement that Berkshire was spending $10 billion on the Dominion acquisition may sound massive, but it's just a tiny fraction of the more than $137 billion in cash that Berkshire Hathaway had on its balance sheet at the end of the first quarter. In fact, Berkshire is only paying $4 billion in cash for the Dominion assets. Buffett is also taking on nearly $6 billion in debt. So this deal hardly qualifies as the elephant-sized acquisition that Buffett has been talking about wanting to do for more than a year now. The article goes on to note that the company's last major deal was the purchase of aerospace parts maker Precision Castparts for $37 billion in 2015. So here's the thing, most articles you read have their own bias and put their own spin on things, but I try to ignore that as best I can and break down the facts for you. I mean, everyone has bias, I'm certainly not perfect, but I do my absolute best to try to put that to one side. And this takes a fair amount of time to research and put these videos together. So if you wouldn't mind taking a moment to smash the like button, I would really appreciate it. So what are the facts here? Well, this is Buffett's first major acquisition since 2015. We can't overlook that this is the first major deal he's done in nearly 5 years. That is obviously a bullish sign. However, we also can't ignore that this deal of $10 billion with only $4 billion paid in cash is a very small proportion of the cash pile that Buffett is sitting on. So it would be wrong to blow this out of proportion and conclude that he has suddenly become bullish on the market. In fact, if we go back to Buffett's comments in May, the picture begins to become a bit clearer. As he said at the time, we have not done anything because we don't see anything that attractive to do. If we really liked what we were seeing, we would do it, and that will happen someday. Now, remember, Buffett is a value investor. He's looking for good value opportunities in the market. As a result, in many ways, he isn't actually too bothered what the overall market is doing. But here's the thing, when companies become overvalued at the end of a bull market, true value is virtually non-existent, and that's why Buffett isn't investing. Whereas when companies become undervalued at the bottom of a bear market, many companies actually begin to trade at a value below what Buffett would consider their true or intrinsic value. In other words, what the market is doing is mostly not relevant. It's only really relevant in that good opportunities are more likely to be found in the worst times and less likely to be found in the best times. So I would go back to Darren Pollock's quote from earlier, where he said Buffett is still willing to make acquisitions where he thinks it makes sense and where it meets Berkshire's hurdle points. As Buffett is a committed value investor and has outlined his unchanging investing philosophy over the course of many years, we know that he must see value with this investment. While we can't know for certain what he thinks about the market, again, nobody except Warren Buffett knows Warren Buffett's thoughts, we can still try to analyse this based on his actions. Well, this move would indicate, to me at least, that he believes there is still value in the market for investors that are willing to look closely enough for it. And let's not forget that Buffett hasn't been sitting on the sidelines doing nothing either. In fact, Buffett has simply been much more active buying and selling individual stocks lately than doing deals for entire companies. Berkshire Hathaway recently slashed its stake in Goldman Sachs and dumped its positions in airlines Southwest, American, United and Delta. But Berkshire has bought shares of Amazon, high-end furnishing retailer RH, and Kroger in the past year. Berkshire also recently lost a bidding war for software and hardware distributor Tech Data to private equity firm Apollo Global Management. So there are bullish signals here. However, while Buffett's actions might indicate to us that he still sees some value in the market, even after the Fed has pumped so much liquidity into it, we must also recognize the size of the deal. The Dominion Agreement's total enterprise value would account for about 7% of the cash that Buffett is currently sitting on, meaning it's not something that's going to move the needle from a balance sheet standpoint. So while this is the most bullish indication that we've had from Warren Buffett for some time, I would guess, and this is just my opinion, that the small size of the acquisition might tell us that Buffett thinks there is still some value in the market, but maybe not that much. Now, what does this mean for the regular investor? You know, people like you and me. I mean, I don't know about you, but I'm personally still living with my family as I'm saving up to someday move out. So I'm not exactly going out there and buying up entire companies like Warren Buffett. Well, in my opinion, and this is just my opinion, I think there are two approaches that can work for people like us. The first is the hands-on approach to finding value. Now, if you're dedicated to analysing the market and committed to spending hours researching to find undervalued companies, you might want to take a look into Buffett's rationale behind investing. Berkshire struck the deal at a low point in the market. Natural gas futures in the US dropped last month to their lowest point in 25 years and have recovered just slightly since. According to Bill Smead, Chief Investment Officer at Smead Capital Management, this looks like confirmation that commodities like energy are undervalued. For Berkshire, the move greatly increases its footprint in the natural gas business. With this purchase, Berkshire Hathaway will carry 18% of all interstate gas transmission in the United States, up from 8% currently. The deal's timing might show that Mr. Buffett sees a silver lining in the regulatory headaches. More barriers for new pipeline build-outs could mean better value for existing ones. The pace of pipeline buildouts has long lagged behind the production of oil and gas, even with reduced production recently. Pipelines will likely have plenty of business going forward. For Dominion, the move is part of its transition to a pure play regulated utility company that focuses on clean energy production from wind, solar, and natural gas. Following the sale, Dominion expects that 90% of its future operating earnings will come from its utility companies that provide energy to more than 7 million customers in states like Virginia, North and South Carolina, Ohio, and Utah. If you're taking the hands-on approach to investing, you should do a lot of research. I've included the source in the description so you can check out the information I've just covered throughout, but you need to do much more research than I can fit into a 10 to 20 minute video. You need to really dedicate several days to researching it. The key thing here is if you're going to take a hands-on approach to picking individual stocks, you need to acknowledge that it's not a part-time hobby. It really is a full-time job. And I would also point out the research shows investing 100% into the stock market, even if you are picking the individual stocks, makes for a very up and down, very volatile set of investments. So even for someone who actively picks the stocks, it doesn't mean you should be 100% invested into the stock market. The second approach is the hands-off approach. And I'll be honest, this is my personal favorite. It involves creating a diversified set of investments and rebalancing every now and then. With rebalancing, it can be as infrequent as once a year or more often, depending on how much time you have and the associated fees. So up here, you'll actually see a video I've created on how to build a diversified set of investments. Click on it now if you'd like to learn more. And of course, thank you for watching.